What we're going to be going over here is franchise fees with an initial down payment. And we're going to look at the accounting from the franchisor's perspective. The franchisor is the company that sells these franchises. So for example here, this National Pizza Corporation, they're going to sell a franchise to a franchisee, or some party is going to buy this franchise here from the National Pizza Corporation. And the terms of the agreement are, it would include here a down payment at signing of $56,000. So the franchisee is going to pay $56,000 cash payment here to the franchisor, the National Pizza Corporation, and in addition to that, they're going to pay 3 annual payments of $28,000 each here. So those 3 payments would equal $84,000 over those 3 years here. So the total cash receipts are going to be $140,000 for the sale of this franchise by the National Pizza Corporation to the franchisee. And the other thing we have to know for this example is the franchisee's borrowing rate, and we're estimating that here at 10%, or 10% interest is what they pay for their borrowing rate here per year. So we're going to be looking at 2 cases here, and we're going to start out with case 1 where there's no future services required here by the franchisor, and the collection on the note is reasonably certain. So franchisor, National Pizza Corporation, has really completed all their services here. So what we want to look at here is how we'd record this here, and we're going to be concentrating on our revenues here for these franchise fees here in our income statement. So what we have to do is we have to break this apart here. We know what the cash payment is, the down payment. We debit our cash here for $56,000. That's our down payment, and that would be recognized as part of our revenues here. But what we have to do is we have to discount those 3 annual payments here at $28,000 each. We have to discount them back to their present value here. So what we would do, we're going to set up our notes receivable here, debit that here for $84,000. Those are the 3 payments at $28,000 each. But now we have to calculate a discount on those notes receivable, and this is a contra account to our notes receivable. And we have to discount those 3 payments back here at that 10% interest rate. So take out your calculator here, and we're going to be looking at the annuity payments, their present value. So we're going to have, on your calculator here, you're going to have these functions here. So we start out with the N, those are those 3 annual payments, 3 years here. Put that in here, and then your interest rate, to put that in at 10% here. And then your payment, well, we got $28,000. Those are our payments here. That would go into your payment key here. And then future value, well, it would be 0 here because we would have paid off all our payments here. So the only thing we have, future value, put that in at 0, hit your present value key, and you're going to come up with the present value of those 3 payments discounted back here at 10%, equal to $69,631. So easy enough to calculate your discount to your notes receivable, your contract account here. You're going to credit that here for $14,368. How do we get the $14,368? Well, we have our notes receivable here of $84,000, and the difference, we would subtract our present value of those 3 payments here, $69,631. So the difference gives us $14,368. So that's what you have to do when you're dealing with those payments here. Those 3 payments, you have to discount them back. No future services are really required, but you still have to know what their present value, and you have to record them as such here. Okay, so we've taken care of our case 1 here, where we had to set up our contra account here, or our notes receivable at its present value. And then let's go back to our revenues here. We didn't mention that here. We didn't finish that. So revenues, those were the $56,000 cash payment here, plus the present value of those annuity payments, or those 3 payments, is $69,631. So a total amount here, credit your revenues here for $125,632. So that's how you recognize your revenues here. You have to break it apart between your cash down payment here, and then you have to discount those, your whatever 3 payments in this case that you are receiving here in the future here. You have to discount them back to their present value. And then both the down payment here, $56,000, plus the present value here of those payments gives us the revenues here of $125,632. Okay, so now let's go over here and let's look at our second case here, case 2. Now this is where the future services are yet to be performed here. Franchisor hasn't completed all the services here. But again, the collection of the note is reasonably certain. So this is what we have to deal with here. Now, here's what we have. We do the same thing. We know what our cash down payment would be here. Debit your cash here for $56,000. And then again, you know what your notes receivable. You set up your notes receivable. Debit that here for $84,000 for those 3 payments here, $28,000 each. Same, set up your discount, your contra account here to your notes receivable here. Same as we did before here at $14,368 here. But the only difference comes in is how we recognize our revenues here. So revenues, moving over here to our income statement for the franchise fee, it would only include the cash down payment of $56,000. So credit your revenues here on your income statement for $56,000. But then with this franchise, the 3 payments that are discounted back there, the notes receivable, its present value, that you would have to set up as an unearned revenue here for franchise fee as a liability account here on your balance sheet. So credit that here for $69,631, the present value of the notes receivable. So you can see what was going on here. When the future future services are yet to be performed here in the case of those 3 semi-annual or the 3 annual payments, then you have to set it up as an unearned revenue here in your balance sheet, again, as a liability account. So you credit that here for the present value of that notes receivable here, $69,631. And you can only recognize the revenues here on your income statement based on the cash down payment here of $56,000. Okay, so we've taken care of our example here, dealing with the last case here where the future services are yet to be performed, but the collection of the note is reasonably certain. Okay, so that'll conclude our discussion.